and that goes towards paying for the policy issuance, handling the claims, etc. Now, Atlas will actually buy reinsurance for the next $1 million of losses that hit the pool. That's a little different, unusual in the industry. Most pools out there, there is no third party assuming some risk. But at Atlas, our underwriters, we want to make sure that our customers are comfortable with the risk that they insure, so that if we're having some skin in the game and taking on some of the risk in the pool, that makes our customers feel a little better. Now, our loss experience in the pool has only been around 1.5%. Now, we did change our pooling program last year. Now, under our new pooling program, our actuaries told us we're going to have at least expected losses of around 4%. Now, again, Atlas is paying most of our losses in the way our program works. Now, what I'd like to do is, let's assume that losses are significant, and let's assume we have a 10% loss ratio. So if the pool has $30 million, that would be a $3 million loss. Now, Atlas is paying about $1 million of that $3 million, so that means $2 million is going to be paid by the other 66 participants. So that means each participant is going to be paying around $30,000. So again, and let me go through those numbers again based on some of the questions here. Our pool size is $30 million at Atlas. The 10% loss ratio is $3 million, and we are paying about $1 million of those losses out. That means the participants pay the remaining $2 million if loss ratios are 10%, and that means each participant pays around $30,000. So if you look at the bottom of the slide here, if a customer does have that 1 in 20-year type of event where the pool hits 10%, we shouldn't see that very often, but even paying that $30,000 claim out, we're still going to be in a much better situation with a captive than no captive, because we're still going to have to pay about half of our income out as taxes. So again, this highlights a point that many customers have, because a lot of customers aren't comfortable sharing risk, but this is not like a normal pool. A lot of the pools in the captive insurance industry are tied to work comp pools or general liability pools, auto liability. Those types of pools you would expect to blow up from time to time. These pools, you do want to see loss activity, but I think it would be hard-pressed to find a pool have significant losses in that 50, 100% range. I don't think that is going to happen, but at the end of the day, you do need to show some loss activity here. Now, most captive managers, they're not doing business in just one area. There's going to be a geographic spread, and it really doesn't matter where the clients are for most captive managers, because at the end of the day, it's really tied to the type of risk you put in there. I've not seen too many managers, except with the exception of the terrorism risk pools, put anything that's specifically geographic in nature. No windstorm, no earthquake. That's not what generally goes into these programs. So what is popular in our pool? Well, crisis management, which would go towards hiring a public relations firm. We could put warranty in there, loss of income from a key customer, loss of income from a key employee. Governmental fines and penalties could be covered under an administrative action policy. But again, this is just a sampling of what could be put in here. All right. All right. So in terms of the investments that most customers put in these, and there are different, on the investment side, there is a difference when you look at different programs on the investment side that can be significant. There are pools out there whereby half of your money is going to be held by some third party, and